Well, it's been another bleak week for the US economy, with housing activity continuing its downward spiral and little evidence that any of the emergency policy settings are working. For his take on things, I spoke to Tom Murphy, managing partner of the independent advisory firm Family Office Research and a close watcher of the US investment landscape. Tom, do you think the risks are growing of another recession in the US?
Alan, I think the most compelling conclusion from the data we're seeing is that the U.S. is going to have very constrained growth for a number of years, probably at least 5 or 6 years, and this is because of the cost of the debt overhang. And as the interest cost constrains U.S. growth, we will periodically have quarters when growth is near zero or possibly negative. It concerns me that the market talks about a double dip and uses terminology like that because that implies consecutive quarters of negative growth. And it's actually not my view we will see that. I think we will see slow growth, and it's occasionally a negative number, but the main point is that growth in the next few years will probably be sub-trend by at least 1%, taking the growth number to 2% or slightly below, which is pretty lackluster growth and not enough to improve the employment outlook in the States.
Yeah, it sounds like you think the argument about a double dip is beside the point.
I think it is. And the outcome, if this were to go on for several years, could actually be in some ways worse than a double dip, because it will be hard for investors to look forward to a period of really good growth in this kind of an environment. And I think investors that look to the emerging world for their portfolio returns are probably correct in making that assumption.
What did you learn from this week's data in the US?
This week's data were very much concentrated upon housing. First we had existing sales, and then we had housing starts. And in both cases, U.S. housing numbers gave us a clear lesson. The latter of those two numbers, which was the starts, was probably the more interesting of the two, because housing starts, which for about a decade were 1.4, 1.5 million a year, are now down around 400 to 500,000 a year, which is a number that's so low we almost have never seen anything like this. And it's not a surprise, because the housing prices in the United States are now at levels that are so far below replacement cost that it's not a surprise people are going toward existing housing rather than new housing. This trend will probably continue.
Bond yields in the US, long bond yields, are at record lows, yet the stock market is holding up. So what do you think of that? Do you think that one of those two markets is wrong?
When we look at a graph on stock earnings yields compared to bond yields, we see that one of the two is quite wrong. And we could either get bond yields rising and share prices rising, in other words, a convergence from both numbers. That's possible. But we could also see investors capitulate in the sense that they give up on cash deposits and move into shares to get yield. Now, buying shares for yield has never been the right reason to buy shares. But there are a number of Standard & Poor's 500 companies in the States, right across the spectrum, whether it's 3M or DuPont or Boeing. I could name probably 10 or 15 right now that have yields well above 2 and in some cases above 3. And if you look at the 2-year bond yield in the States, which is not even 0.5%, that tells us that the cash rate over the next 2 years is going to average less than 2%. In other words, there's no hope for cash management trust type returns in the States over that time frame, meaning that a retiree in the U.S. who's looking for yield needs to go elsewhere.
What you're describing is a reason the stock market will rally, even though growth in the U.S. is going to be minimal for 5 or more years.
Yes, I think that will bring stock market support. And when we look at the graph of what happened in the stock markets from 1933 to 1936 and onwards, an environment not dissimilar to this one, we did in fact see stock prices fall a lot further. But I don't believe in this instance that will happen, because earnings have been strong and company balance sheets in the U.S. are actually becoming stronger as cash builds up. Now, this could result in a couple of things. It could result in a buyback pattern, or it could result in merger and acquisition activity. And the latter of those, mergers and acquisition activity, is certainly what we at Family Office Research are telling our clients is the likely outcome.
So it would be fair to describe you as a bear on the economy, but a bull on the stock market?
Yes, a slight bull on the stock market. It wouldn't surprise me at all that if 12 months from now the Standard & Poor's 500 were up to 1,200 or 1,250 because of the earnings outlook, which is not that bad, and the building cash balances, which I mentioned. Alan, I think the wild card in all this is the banks in the U.S., because the banks have toxic assets, and they have homes which have been foreclosed upon and are building up on their balance sheets. And the last wave of the U.S. housing downturn will probably be the liquidation of those assets, thereby bringing the last wave of the U.S. downturn in housing prices. That's pretty much on the cards for 2011.
Well, on that note, thanks, Tom.
Thank you, Alan.